G'day! In this video, I'm about to show you by far the simplest and most effective means I've found of reading the market after almost a decade of trading. Using a very systematic approach that's repeatedly taking brand new traders and making them consistently profitable in a matter of weeks, not years. This is the exact system my guys are using to pay for holidays, secure prop firm funding, and grow their accounts at an insane rate. Now, it didn't take me long to realize that making money in a bull market's easy. But making money in any market is where the skill is. I spent almost 5 years trading trend lines, RSI, volume, things like that, and it helped me catch really good tops and bottoms in the crypto market. But it also left me with giant periods of time sitting on my hands waiting for something to happen. So just after the peak of the 2021 bull run, I knew it was coming. So I found myself pivoting to Forex. Then last year I could see crypto was putting in another major bottom. So after trading Forex full time for a few years, I decided it was time to jump back into the market. Only this time with a completely different perspective. And that's when I stumbled on something big. By taking what I learned in Forex and combining it with pre-existing strategies I had in crypto and leveraging the volatility from the crypto market, I uncovered a simple, systematic approach to identifying high probability trades with very tight stops and insane reliability. Look, these are the types of trades you can comfortably take with leverage high enough for you to garner gambling accusations. But you know what? It's consistent as fuck. Now listen, before you even think about adding in any indicators or changing anything about this system at all, don't. You don't need to. I've spent well over 5 and maybe even 6 figures on my own education. I can tell you right now what the problem is with most of these paid courses. Most of these guys just repackage well-known concepts readily available on YouTube without really teaching you any kind of application. This just leaves traders lost, confused, stuck, and trying to trade 5,000 different strategies. But this system, it works because it's simple. If you follow this exactly, you don't need anything else. So let's get into it. Without further ado, here's the system I personally forged through years of poverty-stricken tears and heartache.
Welcome to Brockonomics 101. Look, when you think about trading, it is pretty simple. All you need to know are 2 things: direction and destination. Once you understand the market's direction, you just need to figure out the destination. So how do we figure these out? Well, first and foremost, you need to understand fair value gaps. Fair value gaps are a complete game changer, and without them, I'd probably still be poor. Just about everything I do is built around these, and once you understand how they work, you'll understand why. Fair value gaps. Understanding institutional footprints. Fair value gaps are very easily identifiable through candlestick patterns. These print on a chart when aggressive money is being positioned in one direction. When this occurs, market makers are left with their money tied up in the market at these levels. These are also referred to as order book imbalances. The only way for them to get their money back out of the market is for us to revisit those levels. Now, this tells us 3 things on a chart. It will show us the direction the institutions in control of the market are likely trying to push. It'll give us high probability trade entries and high probability trade targets. When markets are trading, candlesticks typically trade back into previous candles in order to offer fair value to investors and balance order books. When they don't, they leave behind what's known as a fair value gap. These are very high probability levels to be revisited. You can spot a fair value gap by identifying 3 candlesticks in the same direction, where the wick from the first candlestick fails to meet the wick of the third. We then highlight the zone between the 2 candles and begin to frame a possible trade entry, or future points of interest for the market to be drawn towards. So as you can see here, the market's pushed up and left behind a fair value gap. We've marked that fair value gap out and anticipated a reversal to come in the future. The market trades back into the fair value gap before continuing the trend to the upside. This would have given us a great place to look for an entry. Now, since fair value gaps show a strong institutional positioning in the market and also a very likely place for a reversal, using these we can start to frame the likely intended direction of the market. When one side of the market is producing strong fair value gaps and the other side isn't, this gives us a roadmap for where the market is likely to turn and in which direction. It's important to note that not every fair value gap is created equally. Knowing where to identify the high probability fair value gaps is going to be crucial to your success. We'll cover that in premium and discount. Market structure. The trend is your friend. Now, market structure is actually a very simple concept to understand. If the market is making lower highs and lower lows, then we are in a downtrend. If the market is making higher highs and higher lows, then we are in an uptrend. Markets don't move in straight lines. They move in what's known as swings. There are different trends on different time frames. Our highest probability trades will come when every time frame is telling us the same thing. By using market structure, we can identify important levels in the market to tell us where the trend is likely changing. This is how to take the guesswork out of buying the dip. Now, markets don't move in straight lines. They move in what's known as swings. The market will make higher highs and higher lows until they eventually get to a target. Then the market will make lower highs and lower lows. And we get a reversal of that trend. Now, the best place to look to enter a trade is when that trend changes. So by identifying these major swings, we can have a look at when the trend is likely going to change and enter here, get in on the market structure shift early and allowing us to trade with the money flow as it changes. Once we get a strong break of that trend with an impulsive move that leaves behind fair value gaps, we can then begin to frame a reversal so that we can enter the trade. And now instead of having to buy the dip before the dip, what we need to wait for is a strong reversal from an important level, enter at the pullback, and wait for that trend to change direction. This is essentially trading. Now let me show you what I mean on a chart. We don't need to overcomplicate this. You just want to take your major swings, right? So you can just run your polyline tool on the left-hand side here. Polyline tool. And just look at your major swings. Now, if you look, not every trend reversal is sustained. And this is why we need to use other tools to help us confirm whether or not it is a true trend reversal. So BTC has continued to trade down through here, making lower highs, lower lows, lower highs, lower lows, lower highs, lower lows this whole time. Right. And down here we get our first sign, potential trend change. And then we get this big, strong, impulsive move from the lows. We get this big, strong, straight up move here on BTC. So we can see the market's going from trending down, lower high, lower low. Lower high, lower low. Lower high, lower low. Lower high, lower low. Higher high, lower low. All right, I'm just going to fake out here. This is why it's important to use other tools, which we'll get into shortly. The market's continued to sell off, lower high, lower low, lower high, lower low. Now, this whole time, people buying the dip didn't need to be doing that. You could have stayed out of the market and waited for confirmation. Now we get this big, strong, impulsive move to the upside. Market pushes up. And then we get our pullback. Now, once we get our pullback, like I said in the video, we're just looking for fair value gaps to enter. Right? The market continues to trend to the upside, and we remain in a bullish market. We remain in an uptrend. Now you should have a strong understanding of market structure. Your highest probability trades are going to occur when market structure aligns on every single time frame. But how do we get extra confirmation in a reversal so that we know whether or not it's a fake out? That's where impulsive versus corrective moves come in. Order flow, the roadmap to institutional intentions. If you can learn to identify order flow, then you will always have a pretty good idea of whether the market is bullish or whether the market is bearish on every time frame. Now, after spending years teaching traders how to read markets, I've found the simplest way to understand order flow is by combining two simple concepts, speed and fair value gaps. Now, when you're trying to frame a directional bias, all you need to ask yourself is two things. Which side of the market is moving faster and which side of the market is producing more fair value gaps? By combining these concepts, you should be able to almost immediately form a bias in your head every time you open a chart. This works on every single time frame and is incredibly powerful. Impulsive versus corrective moves just refers to the speed in which the market is trading in certain directions. Impulsive moves are strong, almost straight up moves towards the direction of the levels the market is targeting. They will usually leave behind fair value gaps. Corrective moves are slow, choppy moves in the opposite direction. Now, these occur because markets do not move in a straight line. We get aggressive money in the direction of the market objective, then slow-moving retracements back into fair value gaps before continuing the move. This is how the market will trade over and over and over again until they get to their target. These are, again, very identifiable on a chart. Now, as discussed before, when smart money aggressively positions in the market, they tend to leave behind fair value gaps. If we can see a strong push in one direction that leaves behind large fair value gaps, and then the retracement of that move is slow moving and leaves behind much less, smaller fair value gaps, then we can develop a strong understanding of the likely direction of the market. It's the direction that left behind the fair value gaps. Now, this may look confusing right now, but in just a short moment, I'll show you how simple and effective this can be. All you need to look at to identify the likely direction of the next move in the market is two legs of money, one leg up and one leg down. By comparing the speed of fair value gaps inside of these two legs of money, it's going to give you a strong idea of what's likely to happen next. Just ask yourself, which side of the market is moving faster and producing more fair value gaps? As you can see here, we've had this big, strong, fast-moving money that's left behind fair value gaps to the upside. Now, on this move down, it's a much slower, more corrective retracement. The market pushes back into a fair value gap, left behind for the move up, and then continues to the upside. Now, based on what you've learned in this video, I want you to try and develop a bias for yourself. Looking at this, are you bullish or are you bearish? Right? Which side of the market is the faster money coming in? Which side of the market is producing fair value gaps? Now, we haven't really given much of a chance for this market to retrace, but so far I've got a bullish bias. So what I'd be looking to do here is frame a bullish trade. Very easy to do that. We're looking for our fair value gap. So we've got 1, 2, 3 candles here. And this is the only fair value gap in this whole leg of money, which makes this a very, very nice trade. I can see 1, 2, 3. The gap between these candles gives me my fair value gap. So I'll be looking to frame a bullish trade here. What I want to see, though, is the speed of this correction. Right? I need to make sure that this side's impulsive and this side's corrective. So if they start picking up momentum as we push into this fair value gap, then I'm not going to be interested in the trade. But if we get this slow-moving corrective retrace into the fair value gap, I can look on our 5-minute charts for a reversal so we can get a continuation to the upside. As you can see, that's exactly what happened. The market pushes up, slow-moving corrective retrace into a fair value gap before we continue to the upside. We can see in this move, we have a strong impulsive move to the downside. You can see on the push up, there are all little tiny choppy candles. Look how many more candles are being produced on the upside here. This is giving us a strong indication that it's just slow-moving money attempting to retrace before continuing to push to the downside. Now, based on what I've just told you, if you came to your chart and it looked like this, you can see this push down and this push back up. You ask yourself, which side of the market is producing more fair value gaps and which side of the market is moving faster? That's going to give you a direction. So are you bullish or are you bearish? Now, if I looked at this, right, the first thing I'm going to do is see these big fair value gaps here. And I know that the market is likely to draw into fair value gaps. So I'm going to mark from this wick to this wick, first and third candles. Then I can see 1, 2, 3 candles here. I'm going to take this candle wick to this candle wick. So the first and third candle wicks. I will label out its fair value gaps. I can see that the fast moving money is coming into the downside. Right? All of this price action is just very corrective. Now, if price continues to push up in this slow movement, as we push into these fair value gaps, I'm going to jump to a lower time frame to try to frame a reversal. So let's see how the market plays out. Now, as you can see, we've got the strong line into the downside. The market is a slow corrective move back into the fair value gap before continuing to the downside. You can see that this is just a slow retracement to rebalance them order books before getting a continued push to the downside. And I'm telling you, this works on every single time frame. Which side of the market is moving faster and which side of the market is producing more fair value gaps? Now you should have a good understanding of when smart money is heavily positioning in the market. Once you see that, you can get an idea of where the market is likely to go next. It should immediately be able to help you form a bias. So how do we get just a little bit more confluence in that so that we can see the confidence that smart money has in these moves? Volume. Identifying institutional confidence. Directional volume has to be one of the easiest ways to understand institutional intentions. Not all candles are created equally. Low volume candles show a lack of conviction in a move. This helps us determine whether there is true institutional interest behind a move or if the market is being manipulated. The best way to understand which direction the market is likely to continue in is to combine order flow and volume. Look at volume as confidence in a move in that direction. Use volume to look at the market and identify which direction the market is moving when volume is trending up and which side of the market is moving when volume is trending down. This tells you where money is being positioned. You can see here that we've got this big, strong, impulsive sell-off. Now, looking at these volume spikes at the lows, we can see that each subsequent spike has come with more and more volume. On the push back up, each of these volume spikes got smaller and smaller. Now, combining that with order flow, we can give ourselves a very strong directional bias about the likely intended direction of the market. And here's a little cheat sheet. All right, now coming back here to XLM on the hourly before it had its massive breakout. Got a very good example here. I can see volume to the upside. As you can see on each of these spikes, the volume is pushing higher. All right, now as we get the sell-off, what does volume do? It's getting lower, lower, lower. All right, you can see the difference here, right? As the move is pushing to the upside, we're getting stronger and stronger volume. The sellers come in and the volume goes lower and lower and lower. And that's good. It shows you that we're likely to get a continuation to the upside. Right, so you're going to be able to develop a bias just by using this order flow. And as you can see, we've got one-sided candles this whole way up. Maybe got a bearish candle, bullish candle, bearish candle. It's slower moving price action. And you can see that the volume is coming in strong to the upside. As you get the retrace, the volume falls off. It's telling us that we're likely to get a bullish continuation. If you have a look here, where did they reverse from it? All right, once again, 1, 2, 3 candles. We draw our gray box, pull it across here. Second, we tap into that fair value gap. All right. The market continues the upside. Now, once again, you can see as they're getting that push up, what's volume doing? Volume is going boom, boom, boom. But it's telling us this trend is likely to continue. You can see this volume increasing as the market pushes up. Let's have a look at a bearish example. Now, you can see here on XRP, right, as the sell-off continued, the volume increased. Right? You can see on these subsequent spikes, we've got the increasing volume. Boom, boom, boom. And the buyers come back into the market. What happens to volume when the buyers step in? We can already see the volume started to fall off, started to decline. Markets continue, keep pushing the upside. Now this whole, look at this whole push back up, volume is declining. There's a lack of confidence in this push to the upside. So once again, what do? 1, 2, 3 candles from the first week to the second week. You can see there's a gap through there. They've just tapped into that fair value gap as they come up to the highs. As you can see, the market eventually sells off. Very, very simple, easy trading. And there you have it. Simply by using market structure, impulsive versus corrective moves, and volume, you should immediately be able to assess the highest probability direction of your trades. But direction is not going to give you enough to know when to enter. That's where we look at destination. So let's take a look at IRL to ERL so that we can develop an understanding of how the market actually works. IRL to ERL. How the market actually works. Now, look, I've been trading a long time. A lot of people argue with me about this. I do this for a living, man. I trade this every single day. I promise you that this is how the market works. And I'm about to show you exactly how well it works. Now, IRL to ERL is a very, very simple concept, but incredibly powerful. It basically tells us that the market always has one of two objectives. We're either trading towards fair value gaps or making new highs and lows. The market will continue to do this until our higher time frame target is met. If we can identify where the market is going on a higher time frame, we can then use our lower time frames to frame an entry and an exit. Remember, retracements aren't random. The market pulls back into fair value gaps. If we have a bullish bias, we don't want to buy as the market makes a new high. Breakout traders are easy money for the big boys. That is exactly how you lose money. Framing an incredibly tight entry on a trade is actually very simple if you're patient enough to wait for a retracement into fair value gaps. Now we can see here the market has had a strong impulsive push to the upside and left behind a fair value gap. Instead of FOMOing in, now we just want to wait for a slow corrective move back into the fair value gap to look for a potential entry. We get our slow corrective move back into the fair value gap, and then we look for a confirmation on lower time frames to enter the trade. After taking a low time frame entry and getting a strong reaction from the fair value gap, we can be confident in at least targeting new highs. This is how the market works on all time frames. If you can identify whether we're trading to a fair value gap or a new high on the monthly chart, then you can break down to your lower time frames, down to your weekly, your daily, your 4 hour, your 1 hour, and look for entries in the direction of that higher time frame target. This applies to every single time frame all the way down to 1 minute charts. Each time frame will have their own IRL to ERL mechanisms at play. Once you establish a directional bias and high time frame direction, then you just need to identify fair value gaps to enter from. Once we trade into those high probability fair value gaps, we just need confirmation through a change in order flow. Now we know the market trades from highs and lows back into fair value gaps before continuing the move in that direction. But not all fair value gaps are created equally. We need to know which fair value gaps we need to be paying attention to, and that's where premium and discount comes in. Premium and discount, where smart money buys. Premium and discount is a very simple concept to understand. In short, institutions do not like to buy things after they've just had a massive run. They'll wait for the market to pull back so that they can load their bags at discount prices. By identifying the discount prices smart money is looking to load their bags at, we can begin to look for levels the market is likely to turn from. And that way we can enter trades with the institutions, instead of buying at bad levels of the other retail traders who end up in the red for months at a time. If you're familiar with fibs, this will be very, very easy for you to understand. All we need for us to identify premium and discount is a strong leg of money in the direction of our buyers. We then run our retracement fibs from the beginning to the end of that leg of money. And we only want to look for buyers underneath the 50. This is considered the discount zone. We only want to look for sellers above the 50. This is considered the premium zone. By combining premium and discount with our fair value gaps, we can now identify very high probability levels for the market to turn from. This is the way the market works on every single time frame. And once you see this, you'll never unsee it. All you need to identify premium and discount is to identify your retracement fib tool and a strong leg of money. First, just click your retracement fibs and apply them anywhere on the chart. If you haven't been trading for very long, there's a good chance your fibs will look like this and everyone will make fun of you. So for premium discount, we want things very simple, like the rest of our trading. If you're using the same color scheme as me, then here's how you should set up your premium and discount. Place your retracement fibs on your chart and double click them. Unselect everything except for 0, 0.5 and 1. I like to change the 5 to red. This isn't necessary, but it's nice to look at. So you want to find a strong leg of money and run your fibs from the beginning to the end of that leg. Then you just need to identify a fair value gap inside of that leg of money underneath the 50. And you have yourself a high probability level to look for a reversal. Now, all of this only matters if you have an understanding of a higher time frame bias. And that's what we use order flow for. So this actually marks the bottom of BTC, this big fair value gap down here. Now, I'm about to show you this on a chart and the way it works with BTC over and over and over again, and how you can identify the smartest levels to be looking for buyers using only premium and discount, then waiting for confirmation through order flow. Now let's put this all together. BTC is in a downtrend. Market's trending down. We get a break to the upside. We get a big, strong, impulsive move that leaves behind a fair value gap. I'm not interested in any fair value gaps unless they're inside of my discount zone. So straight through here, I can see there's a fair value gap inside a discount. Impulsive move up, corrective move to the downside. We're in the trade. Now, if we miss out on this next entry, premium and discount, this leg of money up here, where does the market pull back to? Fair value gap inside a discount, and we push back to the highs. Now, this is where it gets interesting. As you can see, we never came back to discount through here. All right. So there's no entry. So what do? Keep extending your fibs, because eventually, smart money is going to want to get in the trade. So that last retracement, where do we come back to? Fair value gap inside of premium and discount. Where's BTC now? Let's push out. Tap into a fair value gap inside of premium and discount. Impulsive move up, corrective move down. Do we know what's going to turn here? We're not 100%. We need to look at our lower time frames. We need to assess other market conditions. But if we've got a bullish bias and everything's aligning over and over again, the market is going to turn from fair value gaps inside of premium and discount on every single time frame. Now, we have an understanding of exactly how the market works and how to identify a bullish versus a bearish bias and where we want to enter trades. Unfortunately, it's not always that easy. What we want to do is identify the smallest possible, tightest stop loss we can get so that we can maximize and rinse every single cent out of these trades we possibly can. And the best way to do that is by looking at confluent charts. knowing exactly when to pull the trigger. So let's have a look at confluent charts and the ones that matter. Confluent charts, 10x your trade probability. It's been my experience that Bitcoin is not actually the most important chart in crypto. It'll only ever give you a small piece of the puzzle. Not really enough to effectively trade around, that's for sure. There are several other charts that are very important to use when trading the crypto market. Keep in mind, these are just the charts that I use. There are plenty of others. But personally, I think USDT.D is without a doubt the most important chart to use the confluence. This will show you money flowing out of crypto and into Tether and vice versa. It has an inverse relationship with crypto, meaning that if this chart is bearish, then crypto will be bullish. If you can find confluent levels across this chart, as well as BTC, you can be confident the market is very likely to get a turn from that level. Others. This chart will show you the combined market cap of the altcoin market minus the top 10. This is my second favorite chart in crypto. Others.D. This will show you the strength of altcoins versus BTC. Using this chart will show you when altcoins are likely to start outperforming BTC and when we're likely to get that alt season everyone's chasing. BTC.D. This is just the same as using Others.D in reverse. It might help you gain some clarity. ETH-BTC. This chart will show you ETH performance compared to BTC. The reason this chart is so important is because in the past, when ETH has outperformed BTC, it has been the catalyst for every single alt run. This means that until ETH hits a major point of interest, then we are unlikely to see an alt season. Confluent charts. Look, for my own personal strategy, all I use to identify key levels on the chart is cross-chart confluence across USDT.D, others, and the altcoin I'm interested in. I don't even look at the BTC chart. The more similar the altcoin I'm charting looks to the others chart, the better. The reason for this is that crypto can have several outliers in the alt market that make moves on their own terms. By finding levels that align across all three charts, this tells me that it's a very important level to the market and a very likely place for a huge reversal. If you have a look here, March 3rd, 2 p.m. my time, you can see that others has had this big shoving impulsive push down and a slow corrective move back to the upside. Ended up in this fair value gap up here. Right now, at the same time, SWI has traded into this fair value gap here, March 3rd, 2 p.m. And USDT.D has tapped into a fair value gap here, all simultaneously. Now, once you've got an understanding of your directional bias, which we got through others, we can see it's an impulsive move down, slow corrective move up into a fair value gap. That gave us our bias. We got confluence through USDT.D. Found an altcoin inside of a fair value gap as well. All we need is a 5-minute reversal to be able to frame a massive, massive trade. Now, I'd say majority of the trades we take would have to be over 5 or 6R, and extremely high probability because we are looking for 5-minute reversals with confluence across all three charts and a strong directional bias. I'm telling you, these things set up routinely. We've been capturing most of these major swings since November. Right, this system is the most consistent thing I've ever traded in my life. If you can wrap your head around this, you can master this, man. It is like a fucking printing machine. Now that we know the very important levels where the market is likely to reverse from, all we need to do is get an understanding of our reversal pattern. Exactly what we need to see for us to pull the trigger. Right, once we're in them levels, all we need is a 5-minute change in state of delivery. The 5-minute change in state of delivery, the perfect crypto entry trigger. 5-minute change in state of delivery is by far my favorite crypto entry and allows for some insanely profitable trades with very minimal risk. Once the stars align and every other piece of our system comes together, all we need to look for is a 5-minute change in state of delivery to tell us it's time to pull the trigger. This is very, very simple. All we're doing is waiting for the 5-minute chart to tell us that it's finished its trend in one direction and is ready to turn in the opposite direction. This is what a bearish change in state of delivery looks like, and this is what a bullish change in state of delivery looks like. Let me show you on a chart, whole system, and exactly when we enter our trades. And then you can look at any reversal on any chart, anywhere, and they will all have a change in state of delivery. And so if we look at like a 4-hour swings here, every single one of these major swings will have a 5-minute change in state of delivery. Now, we're not trying to catch every single swing. We're waiting for the market to be in completely ideal conditions. So pretend that, we've got our point of interest here. All right. All we need is to see a break above a previous high once we get to that level. All right. So market's trending down, trending down, trending down, trending down, trending down. Boom, we get a break above that. We see this. So we go from trending down. We break above the previous low, previous high. All right, we get that breakthrough here. And as soon as this candle closes, we enter the trade. Get a long position here and put our stop beneath. They need to be very, very, very careful with this and not get stuck on 5-minute charts. You only want to open your 5-minute charts to enter the trade when the stars align, because it's very easy to get caught up in 5-minute charts trying to catch every swing. I'm telling you, if you get 5-minute changing state of deliveries everywhere, and if you're just going to take every single one of them, it's going to chop you to pieces. Very important to know that we only look for this entry after our stars align, after we've got multiple points of interest across multiple charts. All right. So you really want to get good at identifying these, because it's going to tell you when to pull the trigger. Now, if you look at any high, same deal, right? If you look for any sort of major high, I'll show you the exact same thing happen. So come back up here. Now, if you look for any major high, you will see the exact same thing happen. So if you look up here, market's trading up. If you look, we've broken the previous low. Now, this typically would have gotten us in the trade. The reason this system is so effective is because we look for confluence across every single chart. All right. So if you don't do that, if you don't have that confluence on every single chart, there's every likelihood that they're going to run the highs again, right, and stop you out of the trade before you eventually get the turn. The reason this is so effective is because of every single moving piece has been like curated, man, through years and years of studying these markets. I'd say if you're just going to forget pieces of the system, you may as well not trade it at all, because it won't work, right? So what we need to see is a market pushing up. All right, we need to make sure we have that alignment across every chart. Then we see that close beneath the previous low. All right, it can be small. It can definitely be small. We want to see a candle close beneath one of the previous lows. Now, it's going to be much more favorable for you if you look for a strong, impulsive push down. You know, if this leg of money has some fair value gaps inside of it, it's going to be better. It's going to be higher probability, and I'd probably recommend to do that when you first start trading the system. But it isn't 100% necessary if you have complete alignment across all of your charts. They're all telling you the same thing. All right, I promise you, this is such a nice entry, man. Thing is about this is you put your stop at the highs, and as soon as they push past, they break one low, they break two lows, you can move your stop to break even, right? As soon as they sort of push past this second low here, so as you can see, the market's pushed down, all right, and continues to the downside. Once we get past this low here, you can put your stop to break even. So as you can see, this went on to be a, if you held it the whole way, 20-yard trade. Didn't really give you a lot of reasons to get out of this either, right? Because as you can see, they've got the bearish order flow, slow corrective. Let's zoom in a little bit. Got the bearish order flow. You get a slow corrective push to the upside. Yeah, it would have had no reason to get out of this trade this whole way down, right? Honestly, I can't still no reason to get out of this trade. So, crypto has these giant straight moves, giant straight line moves, right? If you were monitoring this trade, that is a 20-yard trade, okay? You need to make sure the stars align though. I'm going to show you exactly what I mean by that. All right, now March 6th. All right. You can see that AVAX has a strong impulsive push to the downside and a slow corrective move back to the upside. If we go to our other chart, they've got a strong impulsive move to the downside, a slow corrective move back to the upside. You can see here they're trading inside of a fair value gap. AVAX, same thing, trading inside of this big fair value gap. And then finally, USDT.D. Now, when USDT.D is at the lows, when they're in a bullish fair value gap, we want to find crypto and others at their highs. Remember, it's an inverse chart. Okay. So you've got USDT.D and a bullish fair value gap at the lows, big, strong, impulsive move up, slow move down, fair value gap at the lows. Others chart, impulsive move down, slow move up, fair value gap at the highs. AVAX, impulsive move down, slow move up, fair value gap. All right. Very, very easy. Now, once we get into that level, all we need to look for to take the trade, once all three charts are aligned, all we need to look for to take the trade is a 5-minute change in state of delivery. All right. Now, what would have happened all through here, AVAX would have been trading this fair value gap for an extended period of time. USDT wouldn't have been in their level yet. Right, so if you're just going to take these before USDT.D and others are ready to turn, you're going to get stopped out over and over and over again. But if you're patient and you wait for all three to be aligned, all you need to do is the market goes from trending up. Well, now I'm zooming here so you can see this. All right, we're in an uptrend, trending up. Keep going. Now, all we need to see is a sweep of one of these previous lows and a close below. All right. Now, as soon as that candle closes below you on AVAX, you enter into the trade. But you stop above the highs and you look to your hourly chart. Because remember, we are only entering these trades because of what the hourly chart is telling us, or the 4-hour. Now we know, right? What does the market do? It trades from new highs and lows into fair value gaps, then back to new lows. So we go down, up, and we can target the previous low, right? Target this low here. So this trade here on AVAX, you've put yourself 11.5R. It is really, really important to make sure you're only trading these with USDT.D and others alignment. If you don't have that alignment, you're going to enter the trade too early and you're going to get stopped out over and over and over again. All right. I know it happens, just speaking from experience. The only way you can get away with this is if you have that complete alignment when you enter the trade. Make sure the whole system is there. Make sure every piece of the puzzle is in place. And I guarantee you can make some serious money just trading this. All right. This was giving us setups once every 2 days for a very long time in a trending market. Now, in slower conditions, you're still going to get 1-2 trades a week, and they're averaging 6+ R, right? 6 times whatever money you risk in the trade every single time, and very high success rate. I'm telling you, man, this is the best system I've found trading any market. The whole entire adult life, trading career, whatever. All right. I'm telling you, this is the business. Now that we've got every single piece of the puzzle, let me show you the checklist so that I can tell you exactly what I look for to entering these trades and how these guys have been pulling some insane profits over the last few months, no matter the conditions. Now we'll go to the checklist and I'll show you exactly what I'm looking for to enter a trade. And this trade hasn't even played out yet. I'm just looking at framing this as we speak. Right, so the first thing I'm looking at is like, okay, I can see a big, strong, impulsive move here. One-sided candles, and they've left behind fair value gaps through here. And so I can look at volume and say, okay, what's volume telling me? Well, I can see is increase in buy-side volume on the move up. Okay, now we've seen that, we want to see decreasing volume on the move down. So you can see this volume is starting to fall off as you get the push down. Now, I can understand that the market is very likely going to continue to the upside. So I just save my premium and discount, and I run it from the start to the top of this leg of money. I can see that we're not inside of discount yet, so I'm not interested in taking a trade. I only want to take a trade inside of fair value gaps that respect premium and discount. Here are my levels. Here are the levels I'm looking to take a trade from. Now that I identified these levels on Ondo, my altcoin, I want to move over to the others chart. Same deal. Others is telling me the exact same thing. All right, we've got a big, strong impulse of led to the upside. Now I just need a slow-moving retracement into discount. Once others gets into this level here, I can look to frame a trade. USDT.D. Right, now this is an inverse chart of altcoins. So if I want to take a long, I want to look for fair value gaps at the highs on USDT.D. It's an inverse chart. So if I'm looking for fair value gaps at the lows on my altcoins and on others, I want to look for them at the highs on USDT.D. Again, I can see a big strong impulsive move down, slow corrective retracement and move up. I want to look at these levels to find confluence. Now, once all three of these charts are inside of their important levels, then I can look for my 5-bear reversal. And our minimum target is going to be this high here. Now, the market can keep running, all right? It can keep running for a very substantial amount of time. And if you've got a 5-minute entry through a fair value gap like this, and the market takes off like this, you can very quickly make a ridiculous amount of money. All right, framing these very, very tight entries by using cross-chart confluence and everything we spoke about today.
And there it is. By now you should be able to read a chart better than 90% of the crypto market. But listen, it's important to note that trading isn't for everyone. That's why I don't sell some $5,000 non-refundable course full of information freely available on YouTube. The real value is in experience and psychological control. So if you are thinking about taking trading seriously, I encourage you to come and chat with myself and my team in Discord so that you can see what it's like to trade with a real community. Just click the link in the description, jump in the free channel and grab the PDFs from the stuff we covered today. But most importantly, if you take anything away from this video today, it should be that you don't need to put your money in the hands of ridiculous Twitter influencers making baseless claims over ridiculous news announcements. Charts will show you objective data and allow you to make informed decisions yourself. If you want to do this right, then take the guesswork out of trading. Ignore the noise, follow the data, and I'll see you in Discord.